It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
You keep drawing that trend, even if it becomes 60% investor versus 40%, over time, the gap's going to get bigger and bigger away from the everyday investors. So home ownership in capital cities will be a thing of the past unless we get some legislation from the government or something drastic changes.
And that is Steve in Sydney on the Real Estate Breakfast this morning. We'll get back to that conversation in just a moment. Talking about your property news this morning and trends, whether you're in Hobart, Darwin, Sydney, Perth, Melbourne, Canberra. We are streaming right now on one of your favourite platforms. It is a Thursday, November the 13th. And good morning to you, Melanie, in London. Thank you so much for your email. Now, you say that you're an Aussie who has been living in the UK just prior to COVID. Man, that is a hell of a time to have made that move. And we kind of forget, don't we, about just how many Aussies were caught out with the pandemic overseas, making the move. Imagine it. You've been saving up to head off overseas. You've got the excitement, you've got the expectation, the joy, the euphoria of going, only to have COVID turn up unannounced. No euphoria then and happy thoughts. This unfortunately happened to you, Melanie, and you found the Real Estate Breakfast around 3 months ago, and you've been catching up on Aussie real estate ever since. Your move, you say, was all about having a European experience, but also just as important was to save as much money as possible and then convert those pounds back into Aussie currency. You're from Perth, and you feel that one thing cancels out the other with the way that the Perth property market has been performing over the last 5 years. You won't be realising as much upside in your money conversion as you initially thought. It's a point that is not lost on a lot of people, Melanie, but at least you are going to be in your first property in the first quarter of next year. So, hey, that's great. And thank you so much for your kind words about the podcast. That is appreciated. Please do let us know how that buying experience goes, and we will simply report it to everybody else. And if you've got a story like Melanie, you might be listening to us from another country and you're saying, oh yeah, that has happened to me. You can either send us that voice message, and you'll find that player in the show notes, or you can send us an email to myrealestatepodcast@gmail.com. We would love to hear from you. Here's an interesting stat: 42 days until Christmas morning. Right, let's go to Sydney and catch up with Steve Palise, who is a buyer's agent there. And a very good morning to you, Steve. Welcome to the Real Estate Podcast. Is that something, do you think, a lot of Aussies can sympathise with? Melanie there losing on some of the pound in that conversion back to Aussie.
Yeah, the pound, and thanks for having me on. The pound's just being smashed at the moment. I actually had a similar experience to Melanie, but I went over when Sydney went into its second lockdown, and I moved to the UK for 3 years with my partner, and they came out of lockdown. So I actually got the best of both worlds. I was gallivanting around Europe while my friends were in lockdown.
One of the reasons why we've got you on this morning is to talk about investor lending in New South Wales, which is skyrocketing. It's something that you have paid a lot of attention to, which is outpacing owner-occupier growth by this staggering 600%. This is according to money.com.au. And we talked about this just a couple of days ago. And new ABS data shows that investor loans jumped 12% this year, while first home buyers barely moved. This is a very big talking point.
Yeah, I agree. So, because I'm a buyer's agent, we actually look at lots of different markets, and one of the main criteria to look at is owner-occupied purchases versus investor purchases. And a lot of the areas we're looking at, where it used to be a healthy market was 70% owner-occupiers and 30% investors. Some of the areas we actually started looking in, it was actually flipped. It's 70% are investment purchases versus owner-occupied. And when we looked at the stats, like you mentioned, the owner-occupied loans are actually dropping and investor loans are actually growing, which is a stark reality reality for if that trend keeps on continuing in the next 10 years, what the market's going to look like.
Yes, that is a really worrying statistic. And you have also warned Australia's housing market could soon mirror New York or London, where ordinary wage earners are permanently priced out. And you're predicting within 10 years investors could dominate home ownership.
Yeah, so this all started actually when I was living in London, and I was talking to, because I work in real estate, a real estate person, and they were telling me how their parents were passing on the lease for their rental to them. And I was like, lease, do you mean like the ground rent? Like they've got some weird systems over there with chain systems. They're like, no, just the lease of the actual property, which baffled me that parents are passing on a lease, not the actual property. And then when I looked into it over there, most of the commercial institutions own the large buildings. So we're not talking about regional, we're talking about typically inner CBD locations and CBD locations. Corporations basically own the CBDs now. So home ownership's completely gone out of London. And the same thing is for New York, mainly because they're priced out. Now, basically, these are commodities. So it's like buying shares and looking at return. They're no longer looking about do owner occupiers actually want them. And that's actually, when I looked at the stats in Australia, we're actually following the same trend. And Australia is obviously a very young country. We're just over 100 years old versus these ones that are, I own a property in the UK that's 300 years old, which is older than Australia in general. But the trend is looking that way, that we're going, that home ownership in these capital cities is going to be a thing of the past.
Yeah, you talk about these big corporations, and of course they've got all of these syndicates. I wonder if fractional ownership, because we've got smaller companies now that are into this fractional side of things where people can invest in very small quantities, that in itself probably leans right into the lane that you're talking about. I mean, that's not going to help.
Yeah, and I'm one of those people who do it. So we run syndicates where we put people together, and like you said, they get that fractional part. So someone who can't afford $7 million house in Sydney can own 10% of that to try to stay in the market. But generally just education as well. Like 10 years ago, like not many people knew about interstate investing and the fundamentals investing. You used to have to look through magazines and talk to someone that you knew. Now there's 1,000 podcasts. I've got 3 books in stores. I'm just a very small fish in a big pond. So the education piece is there, which is expanding what people look at and what they buy. And most people are realizing home ownership isn't actually what it used to be.
We are talking to Steve there in Sydney. We've got more coming up right after this.
If you're a new listener, welcome. We talk to the most knowledgeable real estate experts across Australia every day from 6 a.m.
And right now it is time for another property tip. Recently we were talking to Emma in Adelaide. Emma, you got a good one, talking about buying into apartments, into units, and those balconies. Got to do the right due diligence.
Absolutely. I think if you're buying into any strata complex, it's really important to have a look at the bylaws, the AGMs, and check whether there's any major outstanding maintenance items, because things like balconies can be a major call on each owner. It can sometimes be a 5-figure sum, and that's going to be a nasty sting in the tail for an investor looking for a great return. It's always easy to find this information out by requesting the documents from your agent and also checking all of the strata information that's provided.
Let's explore together the power of real estate.
It is a Real Estate Thursday. Yes, this week is starting to rattle by pretty quickly. Steve is with us. He's in Sydney, and I want to bring up the 1970s, the 1980s. You know, a home cost about 3 times the average income. Today, it's more than 10 times. Inflation, capital growth and wage stagnation. I mean, this is unfortunately created this dangerous imbalance. It's something that you're seeing plenty of. However, we do now have the 5% first home deposit scheme that's in place. How much activity around all of that from your perspective are you seeing?
So it depends what market you're looking at. So if you're talking inner ring and CBDs, it's not going to affect it at all, because most home buyers' limit is not actually necessarily the deposit. Sometimes it's actually the serviceability. Obviously, saving the deposit is quite difficult. On $1 million purchase, 10% deposit plus purchasing costs, you're looking at kind of 130 grand. So it gets them in the door sooner, but they still have the glass ceiling on what they can borrow from banks, because most banks will only lend 5 to 10 times. So it's just giving a lot of activity in the more affordable areas, which is actually bringing migration more to regional areas in the outskirts of the city. What I'm kind of talking about is the middle ring, and the CBD is the one that home ownership is going to be a thing of the past, because it's actually most of the areas that you're looking at is 20 times the average income. And that's one of the macro drivers investors look at as well, is affordability. If the locals can't afford it, who's buying it? Then is it sustainable for investors to keep buying? What return are we getting? But you got to remember, of most markets, it's 70% is owner-occupied purchases in a regional market, for instance. Of that 70%, only around 15 to 20% are first-time buyers. And of that 15 to 20%, only 5 or 7% of it need the actual help for the smaller deposits. So where people are thinking it's going to drastically change the market, but you're only changing 5 to 7% of the market, which is going to give it a kick. But then that new line of where affordability is going to be higher. So if it kicks that market 100, 150 grand, then that's just going to be the stagnation point, and the government are going to have to bring in new legislation to keep the market moving.
And drilling down on Australia's property market, which you've mentioned is being reshaped by this surge in multi-property ownership, this is the key for me. Everyday investors, now it's not just the wealthy, it's the everyday investors. They're the ones that are snapping up multiple homes for rental returns. And of course, that is just fueling everything, exponentially.
It's a self-fulfilling prophecy. So like most of my investors and my friends even, they can't afford Sydney where we live. Like it's actually unaffordable. Like if you're buying middle ring, you're talking $2.5 million plus for people that earn $150,000, $200,000. So that's more than 10 times their income. So they don't have any other choice but to do the rent vesting model or move to a regional area. And most of them, to earn that 150K plus, they need to be in the capital city, Sydney, because they have to go in the office 1, 2, 3 days a week. So they're moving to that rent vesting model, which is, like you mentioned, looking at that return on investment. And that's why they're looking at other areas. So that is the self-fulfilling prophecy, because they can't afford the blue chip locations. They're then increasing the investor activity, which is further separating the gap.
Yeah, and that rent vesting, especially where you are in Sydney, I mean, over the last 5 years, you would have seen that grow so much.
It's actually just ridiculous. Like some of the areas we're looking at have doubled in 5 years' time. And then there's certain areas where, like I said, there's 90% investor activity and only 10% owner-occupier. So you keep drawing that trend, even if it becomes 60% investor versus 40%. Over time, the gap's going to get bigger and bigger away from the everyday investors. So home ownership in capital cities will be a thing of the past unless we get some legislation from the government or something drastic changes.
Steve, great to catch up with you on our Thursday morning, and thank you so much for coming on to the Real Estate Breakfast. Enjoy your run-up to the Christmas break. Catch up with you in the new year.
Thank you so much for having me. Appreciate it.
It's the Real Estate Podcast, talking properties from 6 a.m. every day from every corner of the Australian real estate market.
This was very disappointing for mortgage holders. What's next when it comes to rate cuts next year on your radar?
Yeah, well, the RBA's had to sort of face up to the realities of stronger economic activity over the last 3 months, and of course, that higher inflation figure we got for the September quarter. My sense of it is the economy is performing a lot better than many thought it would. That's seeing business activity pick up, and then I think we're going to start to see business investment and business spending more generally pick up, in which case we're going to be talking about, I think, rate hikes next year, unless of course there's some major financial catastrophe that takes all that off the table. But if the normal flow of the economic cycle continues to play out, I think we're shifting towards a situation where the current cash rate of 3.6% is not restrictive, is not tight for the whole economy, and that we may see some rate hikes in the second half of next year.
We connect you to the best real estate information across Australia. The Real Estate Podcast.